If I told you a major public company's revenue just dropped to like $907 million for the quarter, you would probably assume that business was in deep trouble.
Oh, absolutely. Red flashing lights everywhere.
Right. You'd think they were losing market share, or maybe their core product was just totally failing. But what if I told you that same company in that exact same quarter just hit a 12-year high in cash flow?
It sounds impossible. It really does.
It sounds like a magic trick. But today on Talk Tickers, we are looking at how a Hollywood studio pulled off what looks like the ultimate financial sleight of hand on Wall Street. We are unpacking the raw transcript of the Lionsgate Studios Q4 2026 earnings conference call, which was held on May 21st, 2026.
Yeah, and it's a massive paradox on the surface. You have this shrinking top line, meaning, less total money is coming in the door. But then you have an exploding bottom line.
Meaning they're keeping vastly more of the money they actually do make.
Exactly. And for anyone listening right now who tracks stocks or, just wants to understand the actual mechanics of the modern entertainment industry, this call is a masterclass. It really shows why you have to read past the headline numbers.
I always think of an earnings call like a movie trailer.
Yeah.
Management gets on the microphone and they want to show you the best explosions.
The sweeping romantic kisses.
Right, the dramatic music. They want to hype up the stock. But our mission on this deep dive is to turn off the trailer, sit down, and read the actual script. We need to see if the plot of the business makes any sense at all.
Because a lot of times it doesn't.
Exactly. And for you, the listener tuning in, whether you're a retail investor looking at your portfolio or just someone trying to figure out how a standalone studio survives in this wild media landscape, we're going to translate the dense Wall Street jargon into a clear, actionable narrative.
And the broader context here, the thing we have to keep in mind is that Lionsgate just underwent a fundamental structural change.
The Starz spinoff.
Right. This is the first real look at them operating under a totally new philosophy. They're navigating these massive cross-currents of technology, changing consumer behavior, and heavy industry consolidation.
So let's start with those hard financial numbers, because this is where that plot twist really lives. I'm looking at the core data from the Q4 call. Revenue for the fourth quarter was expectedly down year over year to $907 million.
Yep.
Now, before we get into the why of that drop, let's look at the profitability metrics. Adjusted EBITDA hit a 12-year high of $165 million. That is up 17% year over year.
Which is huge.
It is. And operating income reached $118 million, up over 50% year over year.
We really need to define those terms immediately because they are the skeleton key to this entire earnings report.
Go for it. Break down EBITDA for us.
Okay, so when you look at a traditional business, let's say a company that manufactures physical goods, like shoes or something.
Right.
If revenue drops, profits almost always drop in tandem. It's linear.
Because you sold fewer shoes, so you made less profit.
Exactly. But entertainment is an incredibly lumpy, project-based business. Revenue timing depends entirely on release schedules. So if Lionsgate releases 3 massive blockbuster movies in Q4 of one year, their revenue will be astronomical.
Right.
But if in Q4 of the next year they only release like one mid-budget movie, the revenue is going to be significantly lower.
So the $907 million is just a reflection of what happened to hit the calendar in those specific 3 months.
Yes, and that is exactly why Wall Street looks at EBITDA, earnings before interest, taxes, depreciation, and amortization.
It's a mouthful.
It is, but it's crucial. It strips away the noise of those massive, lumpy production budgets and the accounting depreciation of film assets. It focuses on the actual operational cash efficiency of the underlying business.
So a 12-year high in adjusted EBITDA means that regardless of the smaller total revenue, the studio's machinery is just converting a much higher percentage of every dollar into actual retainable cash.
Precisely. They're running a leaner, more efficient machine.
Okay, I want to pause here and ask for a translation on a few other numbers management throughout there. They reported diluted earnings per share, or EPS, was 23 cents, but adjusted diluted EPS was 37 cents.
Right.
And free cash flow was a really strong positive $190 million. What makes an earning per share diluted, and why does management offer an adjusted version? Like, why give us 2 numbers?
Well, diluted EPS is basically a conservative way of looking at a company's profit. It calculates what the profit per share would be if every single convertible security, like stock options held by executives or convertible bonds, were suddenly turned into standard stock.
Okay, so it assumes the absolute maximum number of shares exist.
Right, which dilutes the profit pool. It shrinks the piece of the pie for everyone. Management provides an adjusted number to strip out one-time accounting charges or maybe restructuring costs or unusual tax items.
To give investors a clearer view of the ongoing everyday business operations.
Exactly. It's the core engine's performance without the one-off hiccups.
That makes a lot of sense. Now, let's tie this cash efficiency to the balance sheet because this was a big focus for me. The call noted their net debt improved by nearly $150 million, bringing it down to $1.6 billion.
A huge move.
Yeah, and the executive specifically said this brings their leverage down over a full turn to 6.1x. For the retail investor listening right now, explain what a turn of leverage actually is.
Sure. So leverage is a ratio. It's a company's total debt divided by its EBITDA. It basically tells an investor how many years it would take the company to pay off its debt if cash flow remained constant.
Okay.
So 6.1x leverage means they have 6.1 times more debt than their annual earnings. A turn is just Wall Street shorthand for one full unit of that ratio.
Got it. So if leverage goes from 7.1x down to 6.1x, they have reduced their debt by a full turn?
Exactly.
So they essentially wiped out an entire year's worth of debt burden relative to their earnings. And management really emphasized this deleveraging is happening naturally.
Yes, that was a key word. Natural.
I'm assuming natural means they are just using the cash from their movies to pay off the debt rather than doing something unnatural like, I don't know, selling off a core franchise or diluting shareholders by issuing new stock just to raise cash.
That is the exact implication. The core business is generating so much raw free cash flow, that $190 million figure you mentioned, that they can literally just pay down their corporate credit cards out of their monthly paycheck.
Wow.
Yeah. Management even addressed a specific external factor called the 3 Arts put option, noting it wouldn't disrupt this natural deleveraging.
Wait, stop right there, because put option is another piece of heavy jargon. What is 3 Arts and what is a put option in this specific context?
Right, sorry. So 3 Arts is a massive talent management and production company. Lionsgate owns a majority stake in them. In corporate acquisitions, a put option gives the minority owners, in this case, the partners at 3 Arts, the right to sell their remaining shares to Lionsgate at a predetermined formula or price at a specific future date.
Oh, I see. It puts the obligation on Lionsgate to buy them out.
Exactly.
So an analyst on the call was basically asking, hey, if these talent managers suddenly force you to buy the rest of their company, is that going to ruin your debt ratio? Is that going to mess up the math?
And management's response was that even if the 3 Arts partners exercise that put option, it would only add about a half turn of leverage.
So bumping them maybe to 6.6x.
Right, which the current cash flow can easily absorb without derailing the broader strategy. It's baked into their models.
Okay, so we've been talking about all these margin improvements, but we really have to contextualize why this is suddenly happening now. Last May, Lionsgate and Starz separated into 2 standalone public companies.
A massive deal.
They collapsed their dual share structure into a single class of stock. Walk us through how this pure play content focus actually creates that 12-year high in cash flow. Like, why is being separated so profitable?
Well, for years, Lionsgate was chained to Starz. And Starz is a premium cable and direct-to-consumer streaming network. Running a streaming platform is just a fundamentally brutal business. It requires massive amounts of capital to maintain subscribers, to market the platform, and to build all the tech infrastructure.
It's a cash furnace.
It really is. By spinning off Starz, Lionsgate effectively tapped out of the streaming wars. They stopped trying to be the grocery store fighting for foot traffic and went back to simply being the farm that grows the absolute best apples, selling them to whoever owns the biggest grocery store.
That's a great analogy. When you aren't subsidizing a cash-burning distribution platform, your operational efficiency just skyrockets. You just make content and sell it at a premium.
Exactly. You focus on what you're actually good at.
So we've established the financial plumbing is working, the debt is going down, the cash flow is at a decade high. But all of this relies on the actual farm producing those apples. Let's look at the creative engine driving the cash, starting with their motion picture segment.
Yeah, the theatrical slate for this quarter offers a really stark look at modern Hollywood economics. We are looking at a tale of 2 drastically different films here.
Yeah, looking at the segment numbers, motion picture revenue was $652 million, which is up 23% year over year, and segment profit jumped an incredible 39% to $187 million.
Impressive numbers.
Very. And this was driven largely by 2 titles, The Housemaid and the Michael Jackson biopic, Michael. Let's start with The Housemaid, because this breaks a lot of conventional rules.
It really does.
The Call describes it as a low-budget, unconventional release. They utilized New Jersey tax credits, and it became the industry's highest-grossing premium video-on-demand title for films with under $150 million in domestic box office. And it eventually hit $400 million globally.
It's wild. To really grasp the mechanics of The Housemaid's profitability, we need to unpack two things. First, production incentives, and second, the modern release window.
Okay, let's start with production incentives.
When management mentions New Jersey tax credits, they are talking about a massive financial lever. States will often offer transferable tax certificates to studios for spending money locally.
So like hiring local caterers, renting local equipment.
Exactly. Hiring local crews.
So if a studio spends, say, $10 million in New Jersey, the state might give them a tax credit for 30% of that.
Right, effectively lowering the actual cash the studio risked to make the movie down to $7 million.
So it mathematically lowers the risk profile before the cameras even roll.
It does. Then you combine that incredibly low initial cost with the premium video on demand, or PVOD strategy.
PVOD.
Right, PVOD allows consumers to rent the movie at home for a premium price, usually around $20, fairly shortly after its theatrical release.
And the margins on a digital rental have to be vastly superior to a movie theater ticket, right? I mean, there's no theater owner taking half the cut.
Substantially superior. In a traditional movie theater, the studio splits the ticket revenue roughly 50-50 with the theater chain. But with PVOD, the studio keeps closer to 70 or 80% of the revenue. So when The Housemaid captures that massive home audience, the profit margin on that $400 million global gross is just astronomical compared to a traditional blockbuster.
You know, I used to think of these low-budget hits like index funds, safe, steady, low risk, but that is the wrong financial analogy entirely.
Totally wrong.
The Housemaid is an asymmetric venture capital bet. You put up a tiny amount of initial capital, the state of New Jersey subsidizes part of it, and the potential upside is a massive 40x return.
It's a grand slam on a bunt.
Exactly. And then on the complete opposite side of the spectrum, you have Michael.
Right. Michael is the global cultural event. Management noted it is on track to gross over 1 billion worldwide.
A billion.
Yeah. It broke the record for the most watched trailer in studio history. It is your traditional massive juggernaut.
This contrast brings up a really interesting point about management's philosophy on tentpoles. Historically, a tentpole was just the $200 million behemoth that held up the studio's entire financial year. Like, if it failed, the tent collapsed.
Yeah, that was the old model. But Lionsgate is actively redefining that term. On The Call, they explicitly pushed away from the idea that a tentpole is defined by its budget.
Which is smart.
Very smart. Instead, they define a tentpole as repeatable IP. It is any intellectual property with a built-in, passionate audience that will return for sequels, spin-offs, and merchandise.
Under that new definition, both Michael and The Housemaid are tentpoles, even though The Housemaid cost a fraction of what Michael did. I mean, they've already announced production on The Housemaid's Secret for a late 2027 release.
It's a brilliant risk mitigation strategy. You scale the budget to match the IP's built-in audience rather than just blindly throwing $150 million at every project and praying it works.
And maximizing the return on these different types of IP requires a really deep understanding of who is actually buying the tickets. Management shared some fascinating demographic data on The Call here.
They really did.
I was totally shocked by this part. We constantly hear the narrative that teenagers are just sitting on their phones and movie theaters are dying. But the executive stated that Gen Z now makes up 34% of the theatrical market.
A third of the market.
Yeah. They view movies as a social, live event, particularly on premium large formats like IMAX and Dolby.
See, the baseline expectation of a moviegoer has evolved. For Gen Z, sitting quietly in a standard theater on a Tuesday afternoon isn't the draw.
No, they can do that at home.
Exactly. The draw is the experiential premium format. It's dressing up, participating in a shared cultural moment, making content in the lobby, and feeling the sensory overload of an IMAX screen. The theatrical exhibition business isn't dead. It is just polarized into premium events.
Meanwhile, the 55-plus demographic is driving the growth on YouTube. The teenagers are at the cinema, and the grandparents are watching YouTube.
It completely inverts the traditional marketing playbook. You can't just buy a 30-second spot on the evening news anymore and expect to reach the kids.
Which is exactly why the marketing strategy for Michael shifted so aggressively. The call highlighted their transition away from traditional ad buys toward creating viral stunts.
Yeah, stunt meaning a real-world activation or a piece of content so surprising that the fans do the marketing organically.
You give the audience the tools to share it, and they spread it on TikTok or Instagram far more effectively than a paid commercial ever could.
Because authenticity is the primary currency for Gen Z. A studio telling a younger audience that a movie is good is often met with skepticism.
Right, it's corporate.
Exactly. But if their peers are engaging with a viral stunt, it elevates the film to a mandatory cultural event.
We've seen how they are managing the flashy, headline-grabbing side of the business with these two distinct types of film releases. But to truly understand Lionsgate's 12-year high in cash flow, we have to look past the movie theater.
We do.
There is a massive, quieter engine running in the background. Let's dig into their television segment and the underlying library.
The television division operates on entirely different financial rhythms than the motion picture group, and it is the absolute bedrock of a pure-play studio's long-term value.
The numbers for TV show a temporary lull but massive underlying strength. Revenue was $255 million, with $31 million in segment profit. Management acknowledged the year-over-year comparisons were tough because of a lull in episodic scripted deliveries.
Right.
But the forward-looking data is wild. 12 of their 13 scripted series were renewed, and they expect to double episodic deliveries in fiscal 2027, with 90% of that hitting in quarters 2 through 4.
That detail regarding episodic deliveries is absolutely vital for an investor to grasp.
Break it down for us.
In television accounting, a studio generally does not recognize the bulk of the revenue or profit for a show while it is being filmed. The revenue is recognized when the finished episode is physically and legally delivered to the network or the streaming platform.
Ah, okay. So if a writer's strike or just a normal scheduling delay pushes a delivery from March to April, the revenue shifts from Q4 of one fiscal year to Q1 of the next.
Exactly. The numbers look artificially depressed in the short term, but the cash is still coming. It's just delayed.
Precisely. And securing renewals for 12 out of 13 shows is an exceptionally high batting average in this current climate. It essentially guarantees a massive wave of locked-in revenue for fiscal 2027.
But the real star here isn't just the new deliveries. The call highlighted that the TV library continues to generate over $1 billion in trailing 12-month revenue, and that is up 5%.
$1 billion from old shows?
Yes. The library is the ultimate financial moat. These are shows that have already been produced, the capital expenditure is entirely in the past, and they have completed their initial broadcast runs.
Right.
The beauty of a library asset is that it requires virtually zero new capital to maintain, but it continuously generates licensing fees. Every time a streaming service needs proven content to reduce subscriber churn, they write a check to Lionsgate.
The executive unpacked the growth of this library with a striking comparison. In fiscal year 2022, Lionsgate had only 4 series sold to the big 6 streamers. In fiscal 2026, they had 17 series on those platforms.
That's massive growth.
And 10 of those 17 ranked in the top 10 on their respective services. We are talking about legacy shows like Mad Men, Nurse Jackie, and Spartacus.
It reveals a huge strategic pivot across the entire streaming industry. A few years ago, the major streamers believed they only needed exclusive original content to win the subscription war.
Right, everyone wanted the next Stranger Things.
Exactly. But the economics of endlessly producing $15 million an hour original dramas proved totally unsustainable. They realized subscribers stay on platforms for comfort food.
Comfort food, I love that.
Yeah, high-quality, beloved library shows with hundreds of episodes. Think The Office or Friends. Lionsgate, by holding onto its rights and operating as a pure-play supplier, is positioned to license these shows at an incredible premium.
And they are feeding that library with a massive current slate. The call ran through an exhaustive list of hits. The Rookie is entering season 9, breaking records on Hulu and launching a spin-off, The Rookie North, with Jay Ellis.
Yep.
The studio on Apple TV swept the BAFTA, Emmy, Golden Globe, SAG, PGA, DGA, and WGA awards. They have Hunting Wives on Netflix, The Rainmaker on USA Network, and the Power universe continues to expand with season 5 of Kanan and a new prequel called Origins.
The diversity of buyers is key there. They are selling to broadcast networks, premium cable, and massive tech streamers. This protects Lionsgate from single buyer risk. If Netflix stops buying, they can go to Apple.
Let me ask about audience fatigue, though. We are talking about an ecosystem heavily reliant on aging properties. I mean, Mad Men ended a decade ago. The Rookie is almost 10 years old. How does a studio keep a 9-season broadcast procedural relevant? Doesn't the audience just age out or move on?
Historically, yes. A broadcast show in its 9th season would face severe audience erosion and an aging demographic, leading to lower advertising rates. But the streaming era has introduced an algorithmic anomaly, which management specifically highlighted regarding The Rookie.
They mentioned an influx of younger audiences, right?
Exactly the opposite of traditional television physics. The Rookie airs its first-run episodes on the ABC broadcast network, which leans toward an older demographic.
Right, traditional network TV.
But then, those episodes drop on Hulu, a platform that skews much younger. Hulu's algorithm surfaces the show to teenagers and 20-somethings discovering it for the very first time.
Oh, wow.
Yeah, they binge the old seasons and catch up to the live run. The Rookie is effectively reverse aging its demographic through algorithmic discovery.
It takes a dusty asset and turns it into an active, regenerating one. And to make sure they're capturing the absolute genesis of new intellectual property, they are heavily utilizing their talent management arm, 3 Arts.
Yeah.
They are expanding into sports representation, signing athletes like Myles Garrett, Mookie Betts, and Jaden Daniels. And they are diving deep into the creator economy, mentioning a client named King Parsons, who turned a YouTube channel into a major motion picture.
This is a sophisticated vertical integration strategy. The traditional boundaries between an athlete, a digital creator, and a movie star have totally collapsed.
Completely.
By managing these individuals through 3 Arts, Lionsgate gets first-look access to the next generation of IP. If a creator like King Parsons already has millions of highly engaged subscribers, Lionsgate can develop a feature film around him, entirely bypassing the costly, traditional Hollywood development and marketing process. They are capturing the audience where it already lives.
So Lionsgate is monetizing every single level of the ecosystem, from YouTube creators to prestige Apple TV, Emmy winners. But the ability to sell all this content relies heavily on the health of the buyers. The streaming landscape is changing rapidly, which brings us to the macro view. Industry consolidation, mergers, acquisitions, it's all shifting.
The tectonic plates of the media industry are moving, and management was surprisingly candid about how Lionsgate views its position in that shifting landscape.
They explicitly discussed the ongoing consolidation, naming Paramount, Skydance, and Warner Brothers Discovery as major players in potential combinations. My initial thought was that fewer buyers must be a terrible thing for a seller.
It's a natural assumption.
Right. If you are Lionsgate and 2 of your biggest customers merge into one, don't you lose pricing power?
It seems counterintuitive, but Lionsgate views this consolidation through the lens of a neutral supplier. Think of the streaming wars not as a gold rush, but as a massive price war between automakers.
Okay, I'm following.
The giant platforms are the car companies fighting for market share.
Yeah.
Lionsgate isn't trying to build a rival car. They're the neutral auto parts manufacturer, like a Bosch, selling the essential engines and brakes to whoever needs them.
And as an auto parts manufacturer, you'd rather have fewer incredibly well-funded customers than a dozen customers on the verge of bankruptcy.
Precisely the thesis management laid out. A combined, well-capitalized streaming buyers, say, emerged Paramount and Skydance, has a massive war chest and an insatiable need for content to feed a global platform.
Because they have to keep those subscribers happy.
Right. They have the financial stability to buy Lionsgate's premium shows at premium prices. 2 isolated, struggling companies facing massive debt maturities are not aggressively buying new content, they're cutting costs. Consolidation strengthens the buyers, making them better clients for Lionsgate's arms dealership.
That reframes the entire M&A landscape. But consolidation isn't the only macro force at play. We really need to talk about artificial intelligence.
Oh, yeah.
The commentary on AI during this call was staggering. Management stated that over 80% of the Lionsgate workforce is currently deployed on AI tools.
80%.
Yes. They named Copilot, ChatGPT Enterprise, Snowflake, and Runway. They're using these tools for productivity, advanced analytics, and crucially, pre-production and post-production.
The sheer speed of adoption is notable, especially in Hollywood, an industry that just endured massive, painful strikes, largely centered around the fear of AI replacing human labor.
It was the core issue of the strikes.
Exactly. But Lionsgate is navigating this tension by deploying AI not strictly as a blunt tool to eliminate headcount, but as a productivity accelerator. Using Runway for pre-visualization or Snowflake for deep data analytics allows them to expand their profit margins by making the creation process faster and cheaper.
But they are taking it a step further than just internal efficiency. They announced a new fan and creator site equipped with digital toolkits. They are going to allow fans to use AI to interact with and remix Lionsgate's intellectual property in a protected environment.
That is a radical evolution of copyright philosophy. Historically, studios function like aggressive law firms. If a fan created a video using proprietary characters, the studio would immediately issue a cease and desist order.
They'd sue you into oblivion.
Right. But in the modern creator economy, user-generated content is the most potent, cost-effective marketing on the planet.
By giving a teenager the AI tools to generate their own mini-movie set in the John Wick universe, the studio is essentially turning its fan base into a massive, decentralized marketing department. They deepen engagement while maintaining control.
That's genius.
But during the Q&A, an analyst brought up the dark side of this democratized technology. The analyst mentioned a film that screened at the Cannes Film Festival that reportedly cost only $500,000 to make, heavily utilizing generative AI, yet it looked indistinguishable from a high-budget studio release.
I read about that.
Yeah. If the barrier to making a cinematic masterpiece drops to $500,000, doesn't the intrinsic value of a massive studio evaporate overnight?
It is the existential question of the decade for entertainment. The analyst was testing to see if Lionsgate is terrified of this incoming wave of democratized competition. Management's response was fascinating, though. They view it as a net positive.
How so?
They made a crucial distinction between the barrier to entry and the barrier to attention.
Right. Just because you can render a beautiful sci-fi movie on your laptop doesn't mean a single person on Earth is actually going to watch it.
Exactly. The internet is already an ocean of infinite, high-quality content. What cuts through that noise? Intellectual property.
Yeah.
Brands. Franchises with decades of emotional resonance.
So while AI democratizes the physical making of a movie, it simultaneously makes Lionsgate's exclusive ownership of The Hunger Games, Twilight, or Michael Jackson exponentially more valuable.
Yes. Lionsgate intends to use these AI tools to drastically lower the production costs of their own massive franchises, driving their margins even higher, secure in the knowledge that a movie featuring Katniss Everdeen will always command an audience over a nameless AI-generated indie film.
The IP is the ultimate filter for human attention. And speaking of the immense value of that IP, we have to touch on a major corporate maneuver that was briefly discussed. The corporate poison pill expired on May 7th.
Ah, yes.
For the listener who doesn't spend their days reading SEC filings, what is a poison pill and what does it mean that Lionsgate just let it expire?
A poison pill is a defensive mechanism used by a company's board of directors to prevent a hostile takeover.
Okay.
If an outside entity, say, a giant tech company, tries to buy up a controlling share of Lionsgate's stock on the open market without negotiating with the board, the poison pill is triggered. It floods the market with new shares, heavily diluting the hostile bidder and making the acquisition prohibitively expensive.
So Lionsgate instituted this defense a year ago, likely to protect themselves during the vulnerable transition period of the Starz spinoff. But on May 7th, they chose not to renew it. Management explicitly stated that while they are focused on shareholder value, they are openly positioned for strategic conversations.
Letting the poison pill expire is the corporate equivalent of taking the not-for-sale sign off the front lawn.
I like that.
Yeah, Lionsgate is signaling to the market, and specifically to those massive, well-capitalized streaming buyers we discussed, that they understand their acquisition value. The balance sheet is clean, the library is pumping out cash, the Starz anchor is gone.
So if a major player like Apple, Amazon, or a combined Paramount wants to acquire a premium pure-play studio with a massive IP backlog, Lionsgate's board is ready to entertain the right offer.
Precisely. They are open for business.
So we have a company with a pristine balance sheet, a powerful macro thesis, and an open door for acquisition. But what if they stay independent? What is management promising for the future? Let's look at their guidance in the upcoming slate.
Wall Street is entirely forward-looking. Management thoroughly explained why the current quarter's cash flow is high, but the stock price depends on what happens tomorrow.
And the promises were aggressive. Guidance for fiscal year 2027 and 2028 points to outsized growth, significant adjusted OEBDA growth, and substantial growth in free cash flow.
Big words.
Very big. But the bedrock of that aggressive guidance is a number that should make any investor lean in. A contractual backlog of future revenues sitting at $1.3 billion. And 90% of that is going to be realized in the next 24 months.
Let's break down why a contractual backlog provides such incredible visibility for an investor. When Lionsgate licenses a movie or a TV show, they sign contracts for specific chronological windows.
Walk us through those windows.
Sure. So a film hits theaters, then it goes to premium VOD, then a pay cable network like HBO for maybe 18 months, then a basic cable network for 3 years. Those contracts are legally binding today, but the cash is paid out incrementally as each window opens over the coming years.
Listener check-in here. If you are managing your own stock portfolio, predictability is the hardest thing to find. A company can project future sales, but consumer tastes change. This $1.3 billion backlog isn't a projection, it is legally guaranteed money.
Right, it's already signed.
If Lionsgate turned off the lights and stopped producing anything new tomorrow, they still have contracts legally obligating buyers to hand them $1.3 billion over the next couple years.
It creates a massive financial runway, allowing them to take calculated risks on their new slate. And the upcoming slate is heavily anchored in that repeatable IP strategy we talked about earlier.
The titles they listed are universally recognizable. We're looking at Michael 2, a sequel to the Michael Jackson biopic, a new Hunger Games film, Sunrise on the Reaping, a new Rambo starring Noah Centineo, a reimagined Blair Witch with the horror powerhouse Blumhouse, and a remake of the classic Magic directed by Sam Raimi.
It is a slate engineered to leverage decades of built-in audience awareness, minimizing the marketing spend required to open the films.
There was also a really fascinating tactical shift regarding Mel Gibson's Resurrection of the Christ, the massive 2-part sequel to The Passion of the Christ. Initially, Part 1 and Part 2 were going to release very close together, but management announced they are splitting them up.
Yes, I noticed that.
Part 1, Ascension Day, will drop in 2026, and Part 2 will hold until 2027 to capture consecutive summer box office quarters.
And analysts questioned this delay, and management's response revealed the flexibility of their operations. They admitted the original dates were merely placeholders. Once they saw the footage and realized the production was coming in under budget, they saw they had 2 exquisite standalone films.
So they changed the strategy.
Yeah. By releasing them in consecutive summers, they avoid cannibalizing their own ticket sales, they allow anticipation to build for a full year, and they secure an anchor tentpole for 2 separate fiscal years, smoothing out their earnings rather than blowing both in a single quarter.
And when we talk about the profit margins on these sequels, the executive revealed something mind-blowing about Michael 2. Because of the way the first film was scheduled, 25 to 30% of the footage needed for the sequel has already been shot.
That is the ultimate margin expander. If a third of your principal photography is already finished and accounted for within the budget of the first film, your cash outlay to produce the sequel just plummets.
It's essentially free footage.
Exactly. The amortization of those costs makes the profitability of Part 2 substantially higher, mirroring the financial efficiency of splitting the Resurrection release.
I have to ask the critical question, though. Michael 2, Rambo, Hunger Games, Blair Witch, are they playing it too safe? If everything is a sequel or a reboot, aren't they trading artistic originality for guaranteed but eventually fatiguing franchise returns? Where does the next great original idea come from if you only make sequels?
It is the eternal tension between art and commerce in Hollywood. But we have to view this through the reality of the 2026 media environment. Originality hasn't vanished. It has just moved its point of entry.
What do you mean?
In today's hyper-expensive theatrical market, risking $150 million on a completely untested original concept is financial suicide for a pure-play studio.
So where do they take the creative risks?
In the low-budget and television spaces, originality is incubated as a $10 million indie horror film or a pilot for a streaming service. If it fails, the financial write-down is negligible. But if it succeeds, if it captures the cultural zeitgeist the way The Housemaid did, the studio elevates it into the massive franchise pipeline. They build sequels, spin-offs, and universes around it. It is a highly calculated risk funnel. They are seeding originality at a cheap price point before graduating it to the tentpole level.
Synthesizing all of this, the 12-year high in margins, the TV library, the AI integration, the $1.3 billion backlog, what is the bottom line for the retail investor trying to make sense of Lionsgate?
The bottom line is that management is signaling the messy transition period is over. Fiscal 2026 was defined by the complexities of the Starz spinoff and the lingering friction of industry strikes. They are communicating that they have emerged from that storm with a fully replenished pipeline, a deleveraged balance sheet, and absolute clarity on their future earnings.
They successfully transformed from a company fighting a losing battle in the direct-to-consumer streaming wars into a hyper-efficient, pure-play content supplier. They are using unconventional asymmetric bets like the Housemaid alongside billion-dollar juggernauts like Michael to generate cash,
while simultaneously utilizing a legacy television library to act as the essential, high-margin comfort food for desperate streaming platforms.
And perhaps most importantly, they are playing the role of the arms dealer in a consolidating industry, selling premium parts to well-capitalized buyers, while quietly letting their poison pill expire, indicating they are ready for strategic acquisition conversations.
The core lesson here for an investor is that in the modern media landscape, top-line revenue is a vanity metric. What dictates long-term survival is cash efficiency, budget control, and absolute ownership of intellectual property.
Cash flow is reality. And before we sign off, I want to leave you, the listener, with a final thought to chew on something that builds on this data but pushes into uncharted territory. We discussed Lionsgate empowering fans with AI toolkits to remix their IP for marketing purposes, but follow that exponential curve 10 years into the future.
The trajectory of generative technology.
Yes. We will eventually reach a point where a teenager sitting in a bedroom can type a prompt and generate a photorealistic, feature-length sequel to The Hunger Games. The lighting, the acting, the visual effects will be indistinguishable from a $100 million studio production created for pennies. When the actual physical creation of cinematic content is democratized to the entire globe and costs essentially nothing, what happens to the intrinsic value of Lionsgate?
The traditional function of a studio, funding the cameras, the sets, the physical production, becomes obsolete.
Exactly. Does the studio of the future cease to be a production company and simply evolve into a massive copyright law firm? Will their only function be holding the legal rights to the characters, licensing out the ability to use the word Katniss or Jigsaw to a global army of bedroom creators, and scraping a 10% royalty off whatever the algorithm produces? The asset will no longer be the capacity to make the movie. The asset will strictly be the legal ownership of the idea itself. The companies that survive the next decade won't necessarily be the ones with the best cameras. They will be the ones with the tightest legal grip on the most beloved ideas. Thank you so much for taking this deep dive with us today. Remember to always look past the trailer, keep questioning the consensus, and we'll catch you on the next one.